Coming up today, stocks rally higher across the board on the back of the first official US trade deal with the UK. What are the odds we're about to see more? Bitcoin rallies above 100,000. Are we still tracking for a recession? The latest from Google. And I invite you to join the resistance and push back on Wall Street by becoming a retail market maker with me starting today. This is an absolute game changer, and I promise you've never seen anything quite like this before. Let's go get it, guys. Well, there we have it, just a month after Liberation Day. We just got the first official trade deal between the States and the United Kingdom, helping to push Wall Street higher today across the board. But before I get into the daily market review as usual, and show you a list of the best performing stocks today, which we're actually getting quite a few of, some of them up over 20% and more. First off, I've got a very special announcement to make that's been a long time making, and I'm proud to say the Market Makers Kit is now officially open. This is the first time I've ever released this to the public, and it's everything I've built over the years to trade options with real edge. Just like a market maker, which I've been fortunate enough to learn directly from one on exactly how they operate. And so if you click the link below this video or head straight on over to my website, clickcapital.io, come to the Market Makers Kit page and you can learn everything about this new product. Inside, you're getting my full strategy, 9 powerful training videos, my custom portfolio delta hedging spreadsheet, absolutely critical in order to trade options just like a market maker, allowing us to profit in any type of market. You also get full access to all 28 of my custom trading view indicators I've made over the years, including any ones I make in the future. I use these every day to pinpoint trading opportunities. And you'll also get access to my new private chat group hosted on Telegram, where I'll be sharing some of my best trades and answering your questions all in real time. I guarantee you've never seen anything like this before, and that's because there's no solid material online teaching us retail traders how to trade like market makers. It's all been kept a quiet secret until now. And so this isn't theory, it's the exact framework we use to trade options like an underwriter. So instead of gambling on options, I'm going to show you how to sell options to gamblers. And for this launch week only, the first 300 founding members can get in with a 50% permanent discount. Just use the coupon code SELLVOL at checkout, because once all these spots are filled, the price will go back up. And I promise I'll never offer this again with a 50% discount, nor will I ever offer a lifetime membership option, just for this launch week only. I've also got a bonus strategy in there on how to spot mispricings in the hugely growing prediction markets. Kelshi for US residents, Polymarket for non-US residents. That's also now big business, trading billions of dollars a day. And so if you're interested in becoming one of the 300 founding members, click the link below this video or head straight on over to clickcapital.io. And once you hit checkout, make sure you enter the promo code SELLVOL to get 50% off, and I recommend taking advantage of the lifetime membership option available only this week. And make the one-time investment today and join me in becoming a retail market maker, looking for real statistical edges across various markets. And I'm going to start sharing some of my trades in the private members chat tomorrow, and I'm building a close-knit community of active traders where we can all search for opportunities together. And so I encourage you to take advantage of this opportunity today, and you can order directly with your credit card, and this could actually turn out to be one of the best investments you ever make. If not, I'll send your money back, offering a 7-day full satisfaction guarantee. And a big thanks to everybody who has already joined today. Please allow several hours for us to process your order and manually approve your access to the members backend, and we'll email you once you've been approved. Okay, just moving back into the daily market review. We've got the official first trade deal, in which the market may have already been sniffing this out and running up into, and appears to be quite pleased with. Looking at some of the price action we're getting across the board today, which I'll show you in a minute. Plenty of small growth names taking the charge today. And according to Howard Lutnick, he's chalking this up as a historic win, the first one of hopefully many, which is going to further open up the United Kingdom market to US companies. And the numbers are that should result in more exports, whilst more tariff revenue, because previously the UK were tariffing US goods 5.1%. That's going to come down to 1.8%, and US tariffs are going from the prior 3.4% to the baseline 10%. And I think that's what's going to really stick. And that'll kind of be the entry fee to the US consumer. Any companies want to sell into the huge and lucrative US market will have to pay that 10% entry fee. In fact, we just heard from the president saying directly it's a good time to go out and buy stocks now. Fear and greed index moving up almost into the center of the greed zone as this bounce continues today. But we just got the latest AAII investor sentiment survey, still got bearish readings above 50%, even for this week. And that's now actually a record, 11 consecutive weeks above 50%. The pessimism is still well and truly alive out there. Even though, like I said, we've bounced almost 1,000 points in the S&P 500 since those first couple of days after the 2nd of April. And we actually found new highs today, but on a bit of a spinning doji. But nonetheless, as my custom indicators are showing, we're still in a risk-on environment here, having recently gone back into it a couple of weeks ago. And just looking at some of the moves we're getting in my themed watch list here, especially in some like energy, getting some big bounces we haven't seen for a while. A lot of stocks popping up on earnings today, and a bit of a reversal of trend of late. There's the ER shares, with its largest holding being private shares in SpaceX. It's another one I've been recently adding to in my long-term portfolio, but we can see all space space exploration stocks doing quite well today. Look at Black Sky, up 31% on its earnings. Nice little pop here in AI. Still plenty of them well off highs from late last year though. But what really blew it out of the park today was quantum stocks. Look at this, D-Wave up over 51% on earnings, even though they only reported 15 million in revenue. Still losing money. Investors are still super enthusiastic for quantum computing stocks. Gave the whole sector a really good rally today, along with AI healthcare stocks and some other smaller growth names as well, catching quite a strong bid here. And whilst the Mag 7 was only up somewhat, Tesla the best, looking at my list of the new Mag 7, more younger, higher growth companies, apart from Uber pulling back from its earnings and Netflix, Spotify a little flat, the others like Palantir up over 7% today. Robinhood, as I pointed out yesterday, was shaping up, looking pretty good. Got a multi-month breakout here on pretty good volume. And the Russell 2000 as well could be shaping up. We actually just got the biggest outperformance relative to the other main indices that we've seen in a while. The Russell up almost 2%, while the S&P couldn't even crack 1. So that's pretty positive technical signs we're seeing here in the market, along with the VIX term structure right at break even. And that's the first time I've seen that since Liberation Day. So we're almost back into a normal state of contango, where the price of volatility is higher the further out you go. From the state of backwardation that we've been in for a month now, we're also getting quite a few moves out there. Bond yields bumping up today, the 2-year 388, after Jay Powell doesn't appear to budge. He's worried about inflation from tariffs that don't even look like they're even going to go into effect above 10%, apart from China, of course. High yield bonds still a little flat, but nonetheless holding above their 50-day VWAP, and the dollar getting a nice little bounce here today, in which it could be offering up a pretty good contrarian opportunity. Just looking back, the last time the market went through a tariff-induced volatility episode, 2018, let's see the dollar come off somewhat, but it recovered and quite well. Whereas this time we've seen one of the worst performances in the dollar for the first year of the presidential cycle, and that's kind of been a dominant theme in financial markets this year. Big exodus out of USD assets. Are we about to see a bit of convergence of this gap, which could also play into the spread of American stocks versus international stocks coming off in tandem with the dollar? Because the fundamentals are there, in my opinion, coming from a spot of real technical weakness, a consensus of US underperformance, combined with extreme positioning, sets out for fertile ground, because the fundamentals actually suggesting, like we've just seen with the UK deal, they're more favorable for the States. Like I've been saying right from the start, it's inevitable we're going to get deals, and those deals are likely to favor the States. They have the most amount of leverage, and especially with an uneven starting point on global tariffs, we're likely to see more and more of these deals, in my opinion. Even though we've had quite a bit of shot to confidence and a few cracks the last couple of months, it's kind of come at a bit of a price. But like the old saying goes, you can't make an omelette without smashing a few eggs. Maybe that's the correct analogy for markets here as well. And while things have been quite messy, maybe all this does turn out to be one big beautiful omelette. And we may already be seeing early signs of that. Just looking at flows into foreign domiciled US equity ETFs. Sharp little bump up these last couple of weeks after coming off super hard the last couple of months. And like I said, the technicals and positioning have been at extremes. Looking at the rolling 4-month performance spread of international versus US stocks, this is the largest 4-month outperformance we've seen of international stocks versus the States, 16.2%. Prior few times we got up around these levels, as markets quite often do, we get that symmetry. Up hard, down hard. Wouldn't be surprised if we see the same thing again. And that's something I'm eyeing up for trading opportunities that I plan on sharing with my members in the private chat room over the coming days and weeks. As how can we potentially position and benefit from a snapback and convergence of USD assets to the rest of the world? I'm looking at a few interesting spreads as I speak. And so whilst we're not totally out of the woods yet with the fundamentals, we do need to see a bounce back in confidence and expectations. They can't stay at rock bottom lows forever. As I always say, the technicals lead, the fundamentals follow. And just looking at breadth in the market has significantly improved with that bullish breadth across all sectors. And just looking a month ago, you can see it was utilities, consumer staples, and healthcare stocks that were performing the best when talking about the percentage of stocks above the 50-day moving average. That's a defensive move, and that kind of started happening even back in December. Defensive sectors started breaking out technically. They held up the best throughout this mess, and we got that rock bottom lows and breadth. You guys remember a month ago on that doomsday, breadth was pretty much as low as it can go. But now we've seen a pretty good bounce back in the cyclicals, discretionary, industrials, financials, and technology. And like I'd also been saying, utilities has been a great place to be for well over a year now, because you're getting the best of both worlds. You're getting the growth from the huge demand in electricity from AI data centers, plus the typical defensive qualities of utilities, much more insulated from tariffs, more stable cash flows and dividend-paying yields. And so there's a look at my sector breadth table indicator, and this is also included in the Market Makers kit. We can see really strong recovery in the short term. Vast majority of stocks above their 20-day and 50-day moving averages. However, we've still got most sectors yet to prove themselves in regards to the long-term trend, 200-day MA. That'll be the next key kind of technical line in the sand to take out to really confirm this bull market's back in action. And as we can see, utilities holding up the best, 77% of utility stocks above their 200-day moving average. And so if we don't go back down and make new lows, if that was the low for the year a month ago, around 4,800 on the S&P, close to close, it wasn't quite a 20% correction. Remember, markets are faster these days. And so if that low holds, that bodes well for forward returns. In fact, the average 12-month forward return is massive, 31%, if the size of the correction's only between 15 and 20%. But what happens next with China? US and Chinese negotiators meeting in Switzerland this weekend. Officials expect a de-escalation. I think we should as well. I wouldn't be surprised to see tariffs dialed back on China, maybe just down to 125% as a sign of good faith, hoping the Chinese can come back with something nice as well. Maybe they agree to buy more US pork and soybeans. But I'd be very surprised if we got an official trade deal. Not saying it's not possible. I just think with China, it may take a little bit longer, and we only just got the first one with UK. But that should get the ball rolling, and I wouldn't be surprised to see more and more countries come out with these trade deals, and maybe that is enough for the market to keep finding its legs here. As I always say, you've got to adapt to the changing environment and new data we got. And just looking at that technical price action across many of the more high beta, risk-on, growth-sensitive names today, that is a very encouraging sign indeed. And so whilst this new trade deal hasn't officially been signed with the UK, we're just getting some loose details now. The market's still pricing it in as pretty much a done deal, 96% here on Polymarket, with the market also saying we're likely to get a deal with others soon, like India and potentially Israel, Australia, and Japan. But we still have a number of countries priced below 50%, and this is the market for trade deals happening before July. So we're talking about the next 6 or 7 weeks here. Another confirming risk-on signal we got today was the liquidity proxy, sensitive to the market's mood. Bitcoin actually ripped up above 100,000, and that was a pretty good sign that we got a good rally in it, considering we got somewhat bad news today. You always want to pay attention when markets rally on bad news. And that was basically the Senate turning down the Genius Act, which is looking to create a framework and regulations for stable coins and other digital assets. With the Treasury Secretary coming out and expressing his disappointment with that today, Bitcoin went completely the other way. Got a nice uncoiling here. We can see volatility was coiling up, as we can see on the volatility heat map indicator, as markets naturally cycle from volatility contraction to expansion. Remember, volatility is more mean reverting than price itself. And so this too is a good risk-on sign for markets. We're approaching all-time highs on Bitcoin. Do we have a really pro-crypto US government? There's no reason why it can't break out to new all-time highs. And that happened with a bounce in the dollar in tandem with a little bit of a pullback in gold as well, which has been one of the best performing assets this year. But this too may be a little stretched and ready for a period of consolidation. And also a little risk-on move in crude, kind of finding its feet after we started the week really weak. It's holding ground here just above $60 a barrel. And so Q2 is going to be really interesting with economic growth and corporate profits. We've seen a lot of front loading with tariffs, even at the consumer level. Seeing good retail sales as people looking to stock up ahead of perceived price increases. But just looking at the Atlanta Fed's latest GDP Now forecasting model, they think Q2 is going to come in at 2.3%, which is pretty good. We can get back to a 2 handle after just printing a negative 0.3% for Q1. That should help alleviate recession fears. But we're still getting plenty of mixed data and forecasts. Just looking at Goldman Sachs' forecast for the rest of the year, they think whilst Q2 will see a bit of a bounce back, they think we're actually going to print a negative Q3 in GDP. And they're also forecasting quite a big increase in inflation. They think we're going back to a mid-3 handle on CPI in tandem with the unemployment bumping up as well. And that's kind of moving towards a stagflation scenario, which is something Jay Powell has been hinting at as well. And like I said, we do still have some mixed data out there. Just looking at consumer credit, it's actually fallen quite dramatically the last couple of months. And that's not a good sign because we've seen this pattern before going into previous recessions. But then we've got others like Standard Chartered saying the US economy might be able to handle any disruption from these tariffs more easily than the consensus on Wall Street. While some like Apollo Global Management put the probability of a recession at 90% this year. But one big cushion we have in the economy, and that's often undernoted and underdiscussed, is the fact Americans have never been more wealthy. Looking at the consumer balance sheet, got over 190 trillion in assets with only 20 trillion in liabilities. And other words, capitalism could come to a grinding halt. Millions of consumers could have their income go to zero, and they've still got plenty of assets and liquidity to spend in the economy. There's a huge amount of wealth in the States, and that kind of acts as a massive cushion for income and spending. That is, of course, we don't get massive deflation in the price of homes or the stock market. Much more sensitive to all this is China. We're already getting many reports of some cracks in their economy, and it shouldn't be all that surprising. They're used to exporting over $500 billion worth of goods to the States every year, and that's pretty much just been turned off like a light switch. And whilst they're trying to tolerate the pain and stand tall, the fact is trade between the States and China is coming to a grinding halt. We can see that in the container bookings have been dramatically falling off, even with this data, which is a few weeks old. I can imagine it's come off even further since then. But as we saw in the investor sentiment survey, there's still plenty of pessimism and the expectation that a recession is on the way. And if enough people think that, we can almost talk ourselves into one. We're likely to get a bounce back in Q2 with GDP, but what about Q3? Is Goldman Sachs going to be right? It's going to come in negative, kind of be a split up recession. If we get that, negative Q1, negative Q3, corporate earnings will play into this as well. Just getting towards the end of a pretty good Q1, S&P still tracking at low double digit year-over-year growth. And as long as that can stay in the high single digits for Q2 and Q3, things could still be okay. And the secular trend of AI infrastructure build-out appears to be still intact. In fact, Morgan Stanley just came out with a research note yesterday. They think there's going to be $2.6 trillion spent on data centers through 2028. That's a lot of money. We all know who's going to benefit the most from that. NVIDIA. And so if all this conflicting signals and data is a little confusing, don't worry, it's supposed to be. Markets are rarely easy. It's really clear what to do when trading the hard right edge of the chart. Looking back in hindsight, everything seems so clear. But what about now? Do we buy the dip? Do we sell the rip? Well, there's nothing wrong with swing trading around all this. But as I've always said on this channel, trying to time entire markets with your entire wealth is near impossible. Few people can successfully do it in the long term, and it's a recipe to drive you crazy. That's why it's always best to stay mostly invested all the time, regardless. I find having separate brokerage accounts helps with that. I have one account dedicated to long-term stock holdings, which I'm always holding stocks in and never short. May just have some spare cash on the side, but always mostly invested, always trying to buy more shares every month, buying more when the markets are dipping or when you see good opportunities in your favorite names. And then have separate accounts for some swing trading, for some options trading, and you can set up hedges in those accounts to help offset any dips in your long-only portfolio. But in my opinion, it's more risky to not stay invested because inflation will eat away at your wealth. The value of a dollar over the last 30 years has gone down more than 50%. Remember, fiat currency is in infinite supply. Central banks literally press a button on their computer and create new currency electronically. Not to mention just the natural growth in credit. Pretty much when new money is borrowed, that also creates new currency. And that's why the biggest risk is not investing. The idea with investing is to grow your wealth at a higher clip than inflation, which protects your purchasing power and thus by extension, your standard of living. And so one company I've been invested in for years and years, and I plan on staying invested for many more years, as I believe they're still the most dominant internet company there is, and the internet's not going anywhere. That's Alphabet Google, but they've been getting bad press of late on reports that their search traffic has come under threat from AI chatbots and that Apple is looking to replace them as the default search engine on their devices. However, they came out with a quiet statement yesterday, posted on their blog. Here's our statement on this morning's press reports about search traffic. We continue to see overall query growth in search. That includes an increase in total queries coming from Apple's devices and platform, pushing back exactly on the rhetoric we've been getting. And they're basically saying they're still growing. People are accessing it in new ways. As I've been saying, I don't think search is going anywhere. I think it's going to be around for decades. Because you think about what it is. As the name suggests, you're searching for stuff. Chatbots are kind of a little different. They're good with information and doing work and crunching numbers, analyzing data, etc. But if you're looking for a new product, you're not going to GPT for that. You're going to Google. You're looking at the latest sports game results. Google. The weather. Google. Not to mention all their other products. Chrome, Google Drive, the cloud, Gmail, YouTube, Waymo, and so on. In fact, Bank of America just crunched the numbers and they assigned a 40 PE for their high growth businesses, which is not all that unreasonable at all. Looking at YouTube, cloud, Waymo, and other bets, and stripping out the cash, that leaves their core services search trading on a 9 multiple for next year's earnings estimates. That's incredible. One of the most exceptional, dominant businesses in the world trading on a 9 multiple. And like I said yesterday, I think in the low 150s, it represents excellent value for long-term investors. We got a little bit of a bounce here today, up almost 2%, and I plan on adding to my position over the coming weeks. Any price under 160 is good enough for me to pick up a few more shares. And just looking at a few more stocks showing up on my screener today, Dave, digital bank, ripping up on earnings here, coming in with blowout numbers as well, 157B beaten on EPS. And does anyone remember Groupon? Had previously been left for dead, ripping up over 42% today, as it also came out with surprising numbers. So you got to pay attention when you see moves like this in the market. These really kind of risk-sensitive names ripping up like this is a strong signal the market's feeling good again. It's willing to take risk. It's willing to assign high multiples to growth because the market had been hoping for a trade deal and we just got one. Interestingly, we'd had a bit of a run-up in the UK ETF. It pulled back a bit today. And there's the spread between American and UK stocks, poking its head above the 50-day VWAP for the first time in a month. I think we've got an interesting setup going on here. And like I said, I'm currently searching for the best ways to play this. Similar to what I had been a few weeks ago on long Bitcoin versus short gold. Did offer up a brief opportunity a couple of days ago, but once again, look at this spread, up over 7.5% today, as we're seeing a significant catch up in Bitcoin whilst gold is pulling back. In other words, I think we're seeing a little bit of an unwinding of this dynamic of a USD exodus, pile in on gold, international outperformance. We continue to see more and more trade deals, which will only be signed by the US if they're more favorable for the US than where we begun with. Fundamentally, that's a good thing for USD assets, especially coming from this oversold starting point. But what happens with China could still be a very different thing. The way I see it now, and of course, this can change a lot day to day, is any official trade deal between the US and China is likely to take months, if at all, this year. I think we'll see a de-escalation. We've probably seen the worst of it, but I just can't see the two world's largest economies coming eye to eye anytime soon. That would kind of be a bit of a miracle, in my opinion. Of course, I could be wrong, and I'll update my opinion as new data comes in, but for the here and now, I just don't see it. The best we can hope for is a deal with India soon, which would be favorable for them, as they're really kind of first in line to replace China, having a huge population of low-cost labor, and Brazil as well, I think, stand to benefit a lot. Again, huge population of low-cost labor, in addition to Vietnam. Interesting to see some of these country ETFs doing pretty well of late. Otherwise, again, we're on the cusp of going into contango on the VIX term structure. My indicators show us, as in risk on mode, we're almost approaching short-term overbought levels, but if we stay overbought persistently in the short term, that's a really good medium-term signal. And the next line in the sand for the S&P 500 will be 5780. If we can print a higher high, then that's technically an uptrend. As always, we'll follow the data and trends as it comes in, do our best to position for it. But the cool thing with options is we can keep our portfolios delta neutral. Doesn't matter which direction the market goes in. We can just hunt for expensive volatility, benefit from the time decay of selling options, and just manage our risk exactly like the market makers do. And so if you want to get access to my custom portfolio delta hedging spreadsheet here, along with all my strategies and tools, including my chart layouts on TradingView, all my watch lists, I've gone through and found dozens of co-integrated stock and ETF pairs, along with trading modules, teaching you all the basics of selling options, how to avoid assignment, along with sharing trades and being able to communicate with other active options traders in the private chat room. Then click the link below this video and head on over to clickcapital.io and use the coupon code SELLVOL to get 50% off the Market Makers Kit and become one of the first 300 founding members today. Because I promise you've never seen anything like it. I guarantee you'll get a lot of value and you'll enjoy being a part of this community. I'm super pumped to meet you all inside the chat room, and a big thanks to everyone who's already joined. Otherwise, that's a wrap for the Daily Market Review today. Thanks for tuning in, and I'll see you back here again this time tomorrow. Cheers.